The views and opinions of this program are those of the host, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading. Today's episode of Market Talk is brought to you by Growmark FS. Keeping up with the latest in ag is a challenge, to say the least, but there are experts nearby ready to help. You'll find them at your local FS. You can trust them to bring you customized agronomic, grain, and energy solutions born of the latest thinking. That's because FS specialists receive continuous training that keeps them current on the latest trends, practices, and technologies. So you'll get local expertise that's both exceptional and up to date. Visit fssystem.com to learn how FS is bringing you what's next. Well, welcome to a weather market. As we came out of the three-day holiday weekend, we saw plenty of volatility, but overall ended up pretty much around unchanged, at least in corn and soybeans after Tuesday's session. Here to talk about what is going on, try to make sense of this for us, and give us some thoughts here on risk management in this volatile market environment. We welcome in Jim McCormick with agmarket.net. Jim, always great to catch up with you. Hope you enjoyed the three-day holiday weekend.
It was nice to have a three-day weekend. We knew coming out of this weekend it could be a lot of volatility, and that's definitely what we got. I mean, I think if anything, Jesse, probably a little bit surprised that we're virtually going to close unchanged. I mean, as we went into this holiday weekend, I think there was two different parameters people were thinking at. Either 2012 was going to be the analog year, and this market was going to accelerate coming out of Father's Day like it did in 2012, or look at 2013 or even last year coming out of the holiday weekend. The market sold off, and we started that grind lower throughout the summer. And, you know, this weekend of the lack of rain, it felt like maybe this market was going to move higher. But as it turns out, it was kind of a lot of volatility, but ended up back where we started, which tells me the market's just not quite certain what's going to happen. There is some rain out there, but it's far enough that there's not a lot of confidence. But on the other hand, Jesse, demand is still a big question mark in our minds, and that we think the government's unfortunately overstating it.
And that's a great way to set that up and frame this up here, Jim, because it just feels like we're getting pulled in two different directions here. On the one hand, as you said, the weather, not knowing what we're going to have for this forecast ahead. You and I were chatting off air. It just feels like this rain that keeps getting forecasted is 7 to 10 days out, and then it just keeps getting pushed 7 to 10 days out. And that feels like to me what traders, a lot of folks were watching on Tuesday. They want to see the latest model runs, and also they want to see the crop progress report Tuesday afternoon, which to me, though, I feel like we already know what we're going to see in that report. We're probably going to see a decline in ratings again, Jim.
All right, let's start with the ratings. The average trade guess is down 3 points on the corn, down 2 on the beans. We're in line with that thought process. I mean, if you're in Illinois and Indiana, you're like, only 3, come on, it should be 10. But, you know, some areas did get rain. The West overall looks good. So I think that's where we're going to even them out. But when it's all said and done, I wouldn't be shocked if we drop it again next week, unfortunately, because the rain we're talking about, especially in the East, folks, does not happen here in Northern Illinois where I'm at until Sunday, maybe into Monday. And right now, the models are saying it's only going to be around 1/4 of an inch. Now, we'll take it. We haven't had much rain at all, but 1/4 inch isn't going to do much considering we're going to be in the 90s and maybe mid-90s according to some models before that rain event comes. But the other thing that we're looking at, Jesse, is the midday model does what it always does on this GFS. It does have a lot of potentially very good rains coming, but they're in that 10 to 15-day portion of the map, which says it's not this weekend, it's next weekend. And unfortunately, they never pull forward. Now, this weekend's rain, what's giving people a little bit of pause is because it is showing up in the local forecast in Chicago, at least on the 5 to 6 day map. So we're saying, hey, Chicago's got a shot. We haven't seen that in a long time, but not a lot of confidence we're going to get that drought busting rain that everyone's looking for.
No, and that's kind of what it just felt like. It gave the market mixed signals, and it really just trading within that range that you mentioned from the overnight session into the day session. And on the flip side of this too, you mentioned demand, and I know coming up June 30th, we got the big USDA report, quarterly grain stocks, acreage numbers. I know that going into this report, it just feels to me that this is a very interesting setup with this weather market headed into what is always a very volatile, very important report here, Jim.
Well, that's it. As for the acreage, we're not looking for huge adjustments in acres because plain and simple, we don't have a lot of, as it turns out, who would have thought? We don't have a whole lot of prevent plant. I mean, there's been a little bit of debate, I think, within the industry of corn and beans. Toward the end of the spring, we're hearing some producers in the northern plains move away from corn and start planting beans. But on the other hand, here in the Midwest, where we were going at a pretty good clip early in the spring, some people argue because we were working in, was going in early, maybe threw in a few more acres of corn. We'll see, but it shouldn't be a big adjustment. The quarterly grain stock's always a hard estimate to get to. I think if anything, there might be a bearish surprise. There's been less livestock numbers to feed. So you could get potentially a bearish surprise. But even then, it comes down to the yield when it's all said and done. And that's where it gets a little bit interesting. I mean, the reality is the government's raised demand almost 805 million bushels year on year. So, in reality, you can really cut this yield hard and you're still not going to, unfortunately, do a huge, damage to the ending stock number, which probably argues unless the rain completely shuts off, this supply-driven rally needs to be taken care of to a market grain.
Well, and thinking about this overall demand picture too, obviously there's some concerns out there about China's economy. We've seen some economic news out of China here to start the week, but also too, I mean, even with the rally in the grains, we're still not necessarily competitive with South America right now. And I mean, just demand is just terrible for U.S. commodities right now, Jim.
No doubt about it. The reality is, Jesse, we weren't competitive before the rally started. I mean, so we're definitely not competitively priced. I mean, late last week on Friday, Brazil was selling corn essentially to China for the same price we were for October delivery, which is not a good sign. But by the time you got to January, Brazil was selling corn $30 a ton cheaper than we are. And that's just a huge problem, for the bull market in the long run, because that's how you get to traditionally very bullish moves, is when you get the buyers. When it's a supply-driven market, it just doesn't last. In 2012, we got about to 840 on the emotional peak. By the time we got to fall, we're down to $7. Still a good price, but $1.40 off the high. In 88, that's the one a lot of people like to think about. One of the hottest, driest years where you had on record. Well, that corn market, when you look at where it started and where it ended coming out of 4th of July weekend. And by the time we got to the fall, we'd given up 75% of that summer emotional supply-driven rally. And that's traditionally what happens in supply-driven rallies. And that's why we're very cautious about this rally, encouraging producers to take a conservative approach, but definitely take take advantage of locking in this move, because history unfortunately suggests that we're going to go down, especially when you figure we're not competitively priced.
Well, and thinking about locking in some of this move, I know some producers might say, well, I'm really concerned about if I'm going to have a crop here with how dry it's been, et cetera, et cetera. But to that respect as well, Jim, I know there's a lot of different tools and strategies out there to manage that risk and take advantage of an opportunity like this that is in front of us here with the last couple of days of rally in the grains, Jim.
Well, there's no doubt about it. I mean, I think you definitely got to be conservative. I mean, when you do your risk management, the whole idea of risk management is to take risk off the table, take some of the emotion off the table, maybe take the stress off the table. If you're in a position, maybe you're where I'm at, Eastern Midwest, hoping for rain, no guarantee it's going to get a rain, but you might consider buying a put, where you could at least put a floor in place. You don't have to go all the way out to the December option. You could buy like an August short-dated put that allow you to put a floor under new crop corn, but through essentially the 3rd week of July, roughly 5 weeks. That'll put a floor in place, but keep the upside open. If you sold a lot of grain, you're feeling uncomfortable about that cash position, then go the other route. Use some options. Maybe don't go out all the way to the December options. Same idea. Go to the August. They've got week 1 options or weekly options where you can buy that'll expire this Friday, expire next Friday. Those are ways to lay off the risk. But one thing I want to point out is because of the demand situation, if you are just, I think, in one of those areas, unfortunately, where it's dry, it's where the risk management may be even more important. Because the worst case scenario is we have a smaller than normal crop, and you're the reason we have a smaller than normal crop. But the reality is we lost supply that we had no demand for anyway, and the market continues to go down. And, the reality is this. We're going to harvest about 94 million acres of corn. 84 million acres of corn. If you you take 18 bushels off the trend yield, that's about 1.5 billion bushels of production. Okay? If you left demand unchanged year on year, you're going to cut demand by about 800 million bushels. The net effect is your carryout's going to be about 100 million higher than the current old crop carryout is, just to put it in perspective. So if that's the case, and you can just carry out somewhere over 1.5, 1.7, 1.8, that's still, unfortunately, I think it's going to be a lot lower than we're trading at the moment. And if you're a producer that has a short crop, it really puts you in a financial hurt because you don't have the bushels to sell. So that may be more important for you, maybe to buy a few more puts just as a way to hedge your risk, because the price may go down even though you have a short crop. So something to consider.
We are being joined today by Jim McCormick of agmarket.net here with our market analysis. Jim, one more thought in corn and soybeans. I just want to get your opinion on here. I know we hit a new high in D's corn overnight, 609, hit a new high in November beans, 1364 and 3/4, almost 1365. I know we pulled back off of that. Psychologically, 1350 in beans, $6 in corn, kind of those psychological levels, but getting above that at least feels like maybe that could be a near-term overhead resistance. What are your thoughts as you watch the charts?
Right now, I think it's a little bit of a red flag. We had to surge last night. It failed in the day session, but I think overall, if the weather patterns stay a little bit drier, crop ratings drop, I think you could get another surge. I would look for beans maybe to get up near 14. That's up near the contract high made earlier. And then in corn, its fall high of a year ago was around 637. I think that'd be kind of the target potentially that we could get if the models keep pushing this rain out and we do not get the rain over the weekend like people are thinking. Those would be the next targets technically I'd look for.
Well, December corn, 597.5 at the close on Tuesday. November beans, 1342 and 3/4. Let's talk the wheat market just a little bit here, Jim. I know Chicago wheat had a decent day while the hard red and hard spring wheats were a bit lower. I'm hearing some dryness concerns in spring wheat country from a few farmers that I talked to, but they have a good chance at rain later this week that could definitely help out. So I felt like the wheat market was a little bit more of an expanded range when it was all said and done on Tuesday's trade. We got the Black Sea issues. I know that's a component. Any thoughts as you watch this wheat market overall right now?
All right, now the funds are still quite short a lot of Chicago wheat. The question is, can you get them scared out of that position right now with this dryness issue? I'm not certain you're right there. I mean, the problem is, Jesse, it's just like the corn and beans. We're not competitively priced. Russia is undercutting the world at the moment. And, it's going to be hard to get the wheat to rally until we get some demand, or unless you just, for some economic reason, get the funds to move out of that position. And the reality is the funds in the last year just aren't really interested overall in owning commodities. That's the we're seeing, disinflation, the Fed raising interest rates. It's caused a lot of that spec money to move out of our markets. And, I'm just not sure what's going to bring it back in without a weather problem. And right now, the spring wheat is a little bit dry, but there is rain in the forecast. And unfortunately, even if the spring wheat yields were down a little bit, with the world and especially Russia having this abundant supply of wheat in the world, it's going to put a cap on the market, unfortunately, near term, I believe.
You mentioned some of the outside market stuff there as well, and I know a little pressure there on Tuesday. Back to some of those economic concerns that are out there around the world, pressure in crude oil. It just feels like I think that goes for grains and for livestock to an extent as well. Just that continued inflationary pressure is something that maybe is not the headline of the day every single day right now in this ag trade, but it's definitely there, and it's something that we need to remember is still underneath this market, Jim.
No doubt about it. You nailed it. I mean, the fact of the matter is the Fed, they came out last week. They're not going to rate, they're not going to cut interest rates anytime soon is pretty much what they're saying. Inflation is still a problem. And until then, they're not going to cut. And as long as they're in this trying to essentially slow down inflation, trying to slow down consumer spending, it is going to drive the money away from commodities at this point in time. And then lastly, commodities are challenging. Anybody who's traded commodities really know there's a lot of volatility. And the reality is some of this money just says, hey, it's easier just go put it at 4.5%, 5% into the money market. Stock markets have been a nice bull market. And I just think those two assets are essentially pulling money away from our market near term, or for hopefully only near term. But they've been away for about a year, and they may continue to be away for a year until the Fed starts changing its policies.
Good thoughts there. Cattle trade tiptoed along on Tuesday, and then we fell apart a little bit into the close. I know on the cash side, front end supplies are tight. Waiting to see what kind of cash activity we'll get this week. But Jim, overall, it just feels like this market maybe has finally run out of some steam here in cattle. I know I say that and I knock on wood because I've said it before, and then we make another leg higher. So, what's your thoughts on this cattle trade right now?
I think you might have nailed it. We may be running out of steam. We did hold the 20-day moving average, I believe, here late in the day, but the emotional aspect seems to be done. This cash markets, I think, is going to start calming down. We're through Father's Day weekend. You're 10 days out, 12, 15 days out from 4th of July weekend. We get through the 4th of July weekend. You get into the hot days of summer, dog days of summer. We tend to see kind of the grilling pressure, demand kind of wane. Economically, we know people are still struggling economically, and that's the time of year you tend to see demand pull back. The hogs, they're still some of the cheapest protein out there, and I think you are seeing some demand shift away from the beef market to the hog market, and hopefully that will provide a little bit of continued support to the hogs. Long term, Jesse, I want to say I don't think the cattle market is going to fall out of bed because of the tight supply, but maybe we're going to trade more of a sideways market and just kind of carve out somewhat of a trading range over the next couple months. Get up a little bit, ration demand, come back down and find the dip buyers on the overall tight supply.
And I know one other point on the hogs too. Cash and cutouts been a bit of a whipsaw, but that provided some support. It felt like on Tuesday, but even hogs are getting up to some resistance levels overhead now as we get into 4th of July weekend, and we're starting to kind of wrap up some of that retail demand, some of that buying ahead of the 4th of July weekend coming up here, Jim.
You nailed it. I mean, right now, then we're just going to see. And then, the reality is the consumers still are we've still got kind of a K recovery. Some consumers are spending a lot of money and other consumers are getting pinched right now and not going out to eat as much. And eventually the market's goals get high enough to ration out demand. And maybe we're in that process of doing that right now in the proteins.
Well, Jim, before we run out of time, I'll open the floor to you. Any final thoughts you have for us? Anything else you want to reiterate for folks here as they're watching this market overall? Maybe on some pins and needles here as we're watching weather forecasts and the economy and much more. What would you say to folks to wrap it up today?
Well, I'm going to wrap it up, Jesse, and just say, there's a lot of tools out there in the toolbox, folks. If you feel like you're overly sold, there's an option plays that you can do to kind of mitigate that risk. Long-term, short-term. On the other hand, a lot of producers were waiting for a summer rally. We market took out 591 early this spring. A lot of people statistically said, hey, this market always takes out that insurance price. We did. We took it out. Now it gets tricky. Some supply rallies are always emotionally driven, and it's hard to sell into the supply side of the equation. But there are ways to take advantage of it. I'm going to encourage you to take advantage of it because, like I said, historically, supply rallies do not last. This year, I think it's definitely a red flag because the demand really looks overstated. And plain and simple, like I said earlier, I think we're losing bushels. There's no doubt about it. But my biggest fear is we're losing bushels that really never had a home. So the net effect is this rally probably won't last, unfortunately.
Well, Jim, if folks need some advice to manage their risk right now, I know they can reach out to you and the team there at agmarket.net. You guys have a ton of great resources, online, phone calls, etc. And I'm sure folks can reach out online. Probably the best way to do that, isn't it, Jim?
Go to agmarket.net, sign up for a research, or if you would like to talk to a broker, you can submit the request to have a broker call you right there online.
Fantastic. Jim McCormick, agmarket.net. Always great to catch up with you and get some insights, sir. Thanks so much for the time, and we will talk to you again soon.
Thank you for having me on, Jesse.
That's going to do it for the show today. Find us online, markettalkag.com. I'm Jesse Allen. Have a great afternoon.